Of all the real estate investment trusts out there, this one is most interesting. First off, read this disclaimer carefully. There is actually a type of REITs that is somewhat more interesting than what we will cover in this video, and that is data center REITs. You can see that their performance is pretty darn good. Let's jump into the real estate ETF. That is the elderly and nursing homes ETF. That's the focus of this video. Here you can see it compared to other REIT ETFs. As far as performance from the 52-week lows, it is outperforming most of these, especially when you take into account the distance from the 52-week highs. Here you can see some price information, and this is the name Janus Long-Term Care ETF. OLD is the ticker. The order of the day is that we will first look at the charts. Then we will look at the internals of the ETF, and finally there will be a very important segment about correlations, which is a hugely big deal in this more and more quantitative market. Okay, after the virus situation, there's been a huge crash in the real estate market. An increasing number of people will work from home, and that is quite clearly very bearish for commercial real estate, and mall real estate will also struggle severely due to the increased popularity of pickup and home delivery, commerce. Residential real estate is also under pressure. That pressure the full force hasn't hit the sector yet. The thing is that gradually commercial real estate will realize that many companies are going to work more from home, meaning they do not need the office spaces they previously rented. This in turn creates a very difficult situation for commercial REITs, and at some point you will see an increasing number of them convert commercial REIT to residential REIT. On top of the economic pressure on residential REITs due to the unemployment rate, you will then in addition have an increased supply. Hence that's bearish for residential REITs. However, the reason why the outlook for nursing home and elderly care, senior care REITs is significantly more bullish, that's because these are highly specialized REITs. It's very difficult to get all of the legals in order to establish these kinds of REITs. Hence, they have that moat, I guess you could say. Okay, so here's the chart. You can see that the first data point we get here is from June 2016, and initially it was nice and bullish. Some clear rally here, from here to there, 50% gain, and that's very impressive for a REIT. During the virus outbreak, you did see a major crash. However, this crash, it doesn't make as much sense as the crash in more the commercial REITs and residential REITs. That's because these, as I said, these are highly specialized REITs. The people who live in these places, they don't really have alternatives. They need to be in a place where there is the access to healthcare providers. So it's a completely different category of REITs. You can see that there's been some rally of the lows, some decent percentage move from here to here. That's 57% gain. The 10-week moving average is a resistance level. but we have pierced it so far this week. If you look at the accumulation distribution line, it is interesting to see that it was higher during this sell-off than it was way back here. Well, let's go to the daily data points. Well, let's quickly get the statistical correlation between this ETF and the S&P 500 is 65%. Not like a super strong correlation, but it is a strong correlation. As far as the daily data points, we are below these, the 200 and 100 day, and we are about to tackle the 50-day moving average, which is, a clear resistance level. The RSI, it is at the highest it's been in a while, which means that RSI is corroborating the current rally. That's good. If we look at the AD line, that one is not corroborating the rally so far. If we take the more bearish perspective, then yes, the 50-day could become a challenge. The purple 20-day moving average, it did kind of function as a support level, but we did slip a bit below it. But all in all, you have a nice cyclical pattern here of rallies and pullbacks. Let's actually measure this. Let's first get the Fibonacci's. Fibonacci retracement like this. Yeah, so we are currently, we have broken through the 38.2% retracement. Let's actually get where are the cycles? Here are time cycles. So this is a very interesting kind of analysis to do. If you do it like this, so here you can see that there are these rising and declining cycles. Let's move the bit like that. Yeah, rising, declining, and we are currently in a rising cycle. Though, according to the cycle pattern, there is a risk that we are just going to go up to the 50-day before the declining cycle reoccurs, but of course there's no guarantee that the cycle pattern is going to repeat itself. Let's actually look at the history and look at the cycle pattern, like here. Yeah, this, yeah, no, not really here. Let's go even further back to see whether the cycle pattern has good predictability. Okay, like here. We have a low, here we have a rally. Yeah, there's some reliability here to the cycle pattern, but you gotta be a bit careful in how you use them. One of the guys that are really good on cycle patterns is Steve Miller. So here is the ETF. Expense ratio 0.35%, not too bad. Assets under management, $21 million, so not that popular. Average daily dollar volume, $438,000. Weighted average market cap, PE, price book. Here you can see the countries. So clearly a very overweight USA, 74%, but there is some diversification here. Yeah, specialized REITs, healthcare facilities. Here you can see the companies. Got Welltower, HealthPeak Properties, Medicis, Omega Healthcare Investors, National Health Investors, Healthcare Services Group. As you can tell by these names, this ETF, it's a relatively pure-ish way to get exposure to this specialized kind of REITs. Here is the educational segment, quant for non-quants. By varied correlations, we just looked at it. We looked at the correlation between the S&P 500 and this ETF, health, senior living nursing home. Okay. By varied correlations, they look at how items move relative to each other, and this is heavily used by quant professionals. So when you hear about algorithmic trading and Renaissance technologies, they heavily use statistical correlations to find opportunities. It is especially valuable for those who want to create market-neutral portfolios. The problem with many portfolios is that the items correlate very, very strongly with each other, meaning even though you have 30 different stocks, they all basically move together, hence you are not really diversified at all. There are two primary kinds of statistical correlations. You have bivariate correlations, and that contains two variables, and then you have multiple regression, which contains more than two. Multiple regression analysis is very valuable, but it can very quickly become rather complicated. Bivariate analysis only compares two items, as I just said. The point is that we want to measure how strong the relationship is between the two variables. And this can vary between -1, which means -100%, to 1, which is 100%. And here are a few examples. Okay, so -1 means the variables move opposite each other. As an example, there is a negative relationship between your age and time until retirement. As your age goes up, the time until your retirement correspondingly goes down. 0 means there is no correlation at all. It's very interesting to find those kinds of stocks. Here is an example. There is no statistical correlation between your age and eye color. A 1 correlation, meaning 100% perfect correlation. One example is your age and the life experience you have built up. These are very exciting times to be in the market, and real estate is certainly is one of the most, if not the most important sector out there. The reason why it is so important is because real estate constitutes the biggest investment for most people, which also means that there is potential for tremendous systemic risk. The huge benefit with the kind of ETF we just looked at, senior homes, nursing home REIT ETF, is that it is a place you live. You are essentially renting your place. Hence, you do avoid the leverage risk, at least for the people who live there. Another thing is that the long-term trend is that we are going to have an increasing discrepancy between the number of young and the elderly. Many people call it the elderly tsunami, which is bullish for these kinds of REITs. Yes, whatever you do, you want to let the trend be your friend, and in this crazy market with bonkers central bankers throwing around trillions, you want to be especially careful.